Investment property, IAS 40. We did previously this IAS 16, PPE, property, plant and equipment. And today we are going to do investment property. Quite related standards, these two are. Now, what you need to understand first that when we say investment property, it means that it has to be a property, which means that it must be a land and building. So it is a land and building which a business owns, but does not use in the ordinary course of business. The language is in the ordinary course of business, which means that a business has purchased some office premises, maybe some land, maybe some building or something. The purpose of purchasing this asset is not to use it for providing goods and services. In fact, you purchase this thing either for rental income. Your intention is that you are going to generate some rental income. You will give it out on rent. Or what you can do that you can make some capital gains. Capital gains means that its value tomorrow will increase and you will sell it and you will make some benefit. In either case, the benefit is there. So if it is rental income, it is benefit. If it is capital gain, it is benefit. So it is your asset. It is your non-current asset. But it is not PPE. The difference between IAS 16, I explained it before, I'll just speak it one time more. IAS 15 and IAS 16 and IAS 40 is that you do not use it, no use in business. And in IAS 16, you use it in the business. I gave you the example before that even if in one building you have two offices, this office, you use it in your ordinary course of business. You have set up your office here, and this premises you do not use. So this one which you do not use, it is treated as IAS 40 investment property, and this one which you use, it is treated as IAS 16, which is PPE. So this is the main difference. Otherwise, both offices are in the same building. Both offices, they might have the same value, but their accounting treatment will be different. So let's quickly see. It says that IAS 40 property, which is land and building or part of a building. It is also possible that part of a building. Why do we call it part of a building? It is possible that this is one building and it has 4 floors. And this floor, you use it for your own business. This, you are using it. This, you are using it. And this, you have given it out on rent to someone else. So this particular one will be treated under IAS 40, and these one will be under IAS 16. So that's why I say that it could be a building or part of a building. So the total building, let's suppose that it is 8 million. And let's suppose that you assume that all of the floors have the same value. So it means 2 million floor, 2 million floor, 2 million floor, 2 million floor. In such a case, 6 million will be treated under PPE and 2 million will be treated under your investment property. So this is, you need to remember. It is possible also that in that building, all these floors are on your usage, you use them, and only one very small part, insignificant. Insignificant means that it is, less than 10%. This is on rent. So if it is so immaterial, if it is an immaterial thing, if it is an insignificant thing, it is 5%, 6% of the total building, then you may take all of that to IAS 16 for making your accounting simplified. So if it is, because it is possible that sometime out of your entire building, only 2 rooms you have given to someone. So for the sake of simplicity, if it is immaterial, you can treat all of that under IAS 16 or both. Held by the lessee under a finance lease, it is possible that it is under finance lease to earn rentals or for capital appreciation or both, rather than use in the production or in the ordinary course of business. So this is exactly the same thing which I explained. The only thing which might be is here, what is finance lease, stuff like that. Finance lease means that it is possible that ABC company has acquired some premises on lease on lease and they have given it out again on rental. So this is what it means. So then it is called investment property. So you might be the owner of the premises, or you might have taken it as a lessee and then you become lessor and you give it to someone else. Recognition of this IAS 40, the same recognition, two criteria for all of your assets. You've got the same two criteria. Number one, that it is probable that future economic benefits will flow to the entity. And number two, the cost of the investment property can be measured. The same two criteria, okay? So there is nothing new to explain. The same two criteria will apply in investment property, the same will apply in intangible asset, the same will apply in tangible asset, etc. The third thing which you need to understand is measurement. How do you measure? And again, measurements are of two types. One is called initial measurement and one is called subsequent measurement. So measurement at recognition means initial measurement. Initial measurement is always at cost. You don't have any other option. Only one option, that is called cost model. Cost model is the same like you have done in IAS 16, which means purchase price plus any other expenses which are incurred to bring the asset to present location and condition. So you take the purchase price plus other related expenses and you add them up and it makes your cost. For self-constructed investment property, cost is the cost at the date when the construction development is complete. Yeah, for self-construction means that you did not purchase it, you are building it up. And building it up means that when the completion stage finishes, until this point, whatever you spent, that is the cost of the asset. This is called initial measurement. Then you have subsequent measurement, which is called measurement after recognition, which means at the end of the reporting date. So now here it is a choice. You've got a choice in accounting policy. So either you do the cost model, which is under IAS 16, or the second option is that you use the fair value model. So IFRS gives you both options, either cost model or fair value model. But here you should remember that there is, from application point of view, in real life and in application point of view, the preference is given to fair value model. For investment property, we generally prefer to use fair value model. Cost model we only use when, so by default, you should be going for fair value. The default category is fair value. If for some reason the fair value is hard to establish, you cannot find out the fair value, only in that case you should go for cost model. Let me repeat it again. You have got PPE, which is your IAS 16, and you've got IP investment property, which is your IAS 40. Okay. Initial measurement is always at cost model in both standards. Okay. But if you speak about subsequent measurement, then you have got under IAS 16, you have got cost and revaluation model, or you've got cost or fair value model. Fair value model, we call it FVM. So this is the difference, okay? But what you should remember that in case of IAS 16, okay, this is cost, I understand in both cases. Here, if you want, you can use cost. If you want, you can use revaluation. And I explained you that if the asset is significant, if the asset is of huge value, like plant and machinery, land and building, you prefer to go for revaluation model. But if you have small assets like furniture, fixture, computer equipment, you go with cost model. Even motor vehicles are in cost model. So cost and revaluation, both are frequently used. Both are parallel used. So no problem. But in case of IAS 40, cost of model is there, but both are not frequently used. Cost model is used very rarely. Mostly you will be using fair value model, okay? Fair value model is your choice. Now, fair value and the revaluation model, the value of the asset is same. For example, if I have this, like I told you, that this my building, within building I've got 2 apartments, This apartment is under IAS 16. This apartment is under IAS 40. I purchased both of them for 100K, and I purchased this also for 100K. And then 1 year passed, and then I say, let's do revaluation. When I do revaluation, it becomes 120K. I ignore the depreciation for a moment. And this one also is 120K. So when you do revaluation or fair value, so revaluation and fair value, the value itself is not different. The value itself will remain same. It is not like revaluation model value will become 130 and fair value model value will become 120. No, the market, because fair value and revaluation is done on the market value. So market value is 120K in both cases. But the difference is that in revaluation model, you do depreciation, you charge depreciation. In fair value model, there is no depreciation. So remember that when you are valuing some asset on fair value model, you do not calculate depreciation for that. Instead, what you do, that you have got your fair value in this year, and then you get fair value in the next year. And if there is any decrease or increase in the fair value, that is considered as gain and loss. So fair value will be compared with fair value. You do not do depreciation. Now, why you do not charge depreciation? The reason is that depreciation, you charge it into your P&L or income statement. This asset, which is under IAS 40, from the very beginning, we said that we are not using it in the business. So income statement is for the business revenue and the expenses which are incurred to generate the revenue. So this asset does not have any connection with this revenue. This asset is not used in the business. So I don't calculate its depreciation. I'm not using it. I've given it on rent. Somebody else is using it. They will have their own rentals or whatever. The treatment in fair value is that you only compare 2 years fair value. You take 2 years fair value, and whether it is a gain or whether it is a loss, that is taken to your P&L. Now, that is a very important point to remember. Very important point to remember. And you should be very clear. IAS 16 and IAS 40. Okay. When you do revaluation, so you have a revaluation gain, or you might have a loss, whatever. This goes to OCI. And this goes to P&L. This is what you should remember. IAS 40 investment property. And I will tell you why. First you say, okay, I remember, but then you may ask me that, okay, I know I have remembered the rule, but what is the logic behind that? And there should be a logic for everything. I mean, we don't do any, without things without a rationale. So I'll give you the logic. First, you remember that it goes to P&L, it goes to OCI. Yes, like I before explained you, that if you had any impairment loss in past, then first you recover that loss, you charge that gain into, that was I explained you in IAS 16, that let's suppose this asset, an asset had impairment loss. Impairment loss means a decrease in value of 20K in year 2019. And then the same asset, it has a revaluation gain of 100K before it was a loss, 100K in year 2020. So what do we do? Now, because this asset, previous year, last year, we recorded a loss of 20K. So asset was here, it went down by 20K, and now it is going up by 100K. So what we need to do, that this 20K, which we recorded in the P&L last year as a loss, now we take to the P&L 20K as a gain, so that we reverse the loss from the past, and then remaining OCI, we charge 80K. This is gain. This is the treatment of IAS 16, gains and losses. And I explained this thing in last class also. Whereas if you speak about IAS 40, it straight goes to P&L. There is no concept of taking it to OCI, other comprehensive income. You might be saying that it is unrealized. You might be saying that it is unrealized. Why do you take it to P&L? Because we learned that unrealized things, they go to OCI. But my answer is that no, even if it is unrealized, still take it to P&L. Now, let me tell you the reason why do I say that take it to P&L. Listen, this is the building. We purchased this office to run our own business, and this is under IAS 16. Now, you are the manager. You took a decision, purchase this office because you want to set up your operations, which was a necessity for the business. And then you purchase this office as well. And you said that this is my investment property. I'm taking it to IAS 40. And you paid 100K for this office premises, and you pay 100K for this premises. Now, my question is that as a manager, who took the decision to purchase this thing? You took the decision. Why did you take this decision? Because you thought that I have some extra funds in my bank. So bank is giving less return. Let's take out the money from the bank and purchase this premises. It was not needed in the business, my friends. We are not running or operating our activities from here. Why did you buy? Who purchased it? Oh, Jinesh purchased this. Mr. Jinesh, did we need that thing? No, we did not need that thing. Why did you do that? Because I thought that we will make money. So this is your decision, okay? This is purely a manager's decision. It was not a necessity for the business. So when it is a manager's decision, if you remember that PBIT part, the above part is P&L. So any gains or losses should be here, because you as a manager are taking a decision, and then you should take the ownership. If you earn something, you will be happy coming up and say, you know what, I took this decision and the value of the property has gone up, the business has made 50K, this is because of my decision. And I'll say, yeah, it is because of your decision. Otherwise, the money was lying in the bank. Thank you very much. You should be credited for that. I accept. Take credit. It was your decision. But if it is a loss, then you should also take the ownership. So therefore, anything which you make gains and losses on IAS 40, you take them to P&L. Is it clear?
Yeah, yes, clear for me.
Okay, great. Now, one more thing, what you should remember, it is possible that, and that is very common, that you have this premises, whatever, or let's call it one premises. You have it until January to June 30th, and this is December 31st, okay? So this premises, you have been using it in your own business. So when you were using it, it was IAS 16. And then on 30th of June, you decided that we don't need this warehouse, or we don't need this premises. This is extra. And then what you did, you gave it on rent. You rented it out. As soon as you rent it out, it becomes IAS 40. So what you need to do, and you remember that whenever you make some classification, change in the classification of asset, you must revalue it, because under IAS 16, it might be on the book value. It is possible that I was treating it at net book value, which means the cost model. But when I converted it to IAS 40, I should be doing it on fair value. So two things you should remember. Number one, from January to June, the 6 months, depreciation you should calculate, because for the first 6 months, this asset was under IAS 16 and you were using it. So 6 months depreciation must be calculated. Number two, on this particular date, you should also calculate any revaluation gains or losses. This should also be calculated because you are changing the classification. Asset before was on cost model. Now it is on fair value model. And then last 6 months, no depreciation. Because you remember that now it is on fair value, it is under IAS 40. So last 6 months from July to 31st December, you will not charge any kind of depreciation, no depreciation. But you do have a fair value here, and you will calculate the fair value here. So you will have a fair value on 1st of July, you will see a fair value on 31st of December, and any change in the fair value should be reflected to P&L. Now let's suppose that the fair value in the beginning here, it was 100K. And then the fair value at the end of the year, it is 90K. So I can see that there is a loss of 10K. Now, in relation to this asset, your P&L, what will go to P&L? Into P&L, you will take the depreciation of 6 months. This amount you will take P&L, plus you will take the loss in fair value. This will also go to the P&L. So your P&L will be hit by 6 months depreciation and then the loss here. And nothing goes to OCI. But if you have this thing, how to say, and by the way, in OCI, you might have the gain. If there is any gain or loss, that goes to OCI at this stage. If there had been a gain, let's suppose it is not 90K, let's suppose that it is of 20K to the P&L. So this is, the switching. When you make a switch, what you need to understand that when you make a switch, you only calculate 6 months depreciation and that goes to your P&L. And then the remaining 6 months, no depreciation, but I do calculate the fair value, and any gains and losses in fair value should be reflected into P&L because now it is IAS 40. One more thing you should remember, which bothers students. I said that IAS 40 investment property, the preferred measurement is fair value model. This is the preferred method. And so we said that IAS 40, the preferable method is fair value method. But in some situations, it is possible that there is an asset for which you cannot find out the fair value. Because fair value is the market value. And market value, many assets do not have a market value. Why they do not have a market value? Because there is no active market available for them. It's a specially constructed asset for you. It might not have an active market. If the fair value model you cannot apply, then you should take the cost model as IAS 16. And the question always students, they ask that should now I depreciate the investment property or not? This is the question. Because as a general rule, what remains in our mind that investment property should not be depreciated. And I have said this thing 5 times in last 20 minutes. Don't depreciate investment property. And then the question comes that if you take fair value model, if you cannot calculate, if you cannot apply fair value model to investment property, then IAS 40 says used cost model as IAS 16, So should we depreciate or not? The answer is yes. Then you should depreciate. In this case, investment property will be depreciated because the standard says, the standard IAS 40 does not tell you that you should depreciate or not depreciate. IAS 40, open it up, it is not written anywhere that you should depreciate investment property or not. But IAS 40, it says you that used cost model as IAS 16. That's all. So when it says use cost model as IAS 16 and IAS 16, it does have depreciation. So it means that if I'm taking IAS 16 cost model, I should presume that I should be taking depreciation as well. So this is one thing you should remember, that in those cases where you use cost model for investment property, in that case, you should depreciate the asset as well. Now, here comes the question to your answer. Just like in the break, you were asking me that if I work in an SME and I have an asset and then I change the asset. So I'm an SME. And before it was 16, now I want to make it 40. Here I was doing it cost model. Here, preferably, I should use the fair value model. I don't want to, and here I should do revaluation. And you were asking me, should you do revaluation or not? I said, you can do it or you may not do it. Because if you are an SME and you don't want to give extra $5,000 for revaluing your asset, because revaluation will cost you something, you will use some outside party. So you may decide that I continue under, because IAS 16 it allows me, I continue to use cost model here as well. I'm using IAS 16, IAS 40, but I'm using cost model because it is allowed. So if it is allowed, then you don't need that thing as well. So these are some core points to remember. Fair value model, I already have explained you. The investment property, it says that investment property is not depreciated. It is not depreciated as long as it is held under fair value. As long as it is held under fair value. Now, one thing you should remember. Now, this is end of the chapter, okay? Now, there is some example and that's all. Chapter is finished. Let me just, last thing I should explain you here. See, if I have IAS 40, if I have IAS 16, many companies, they use cost model. But then at some point in time, they decide to switch to revaluation model. When they decide to switch to revaluation model, it is appreciated by IAS. It is appreciated because revaluation model, cost model is your entity specific. You are not seeing what is the price of the asset in the market. You are only seeing your own book value minus depreciation, which might not be real. So when you decide to move to revaluation model, it means that it is possible that accounts will be more accurate because revaluation model is market specific, and the numbers you take it from the market. And now this is the true reflection of the value of the asset in the market. So it is fine. It is good. In under IAS 40, you have it at fair value model. And then you say, I want to move to cost model. You want to make a switch to cost model. Now, that is actually not really very much appreciated by the auditors and by the standards. Because cost model is supposed to be less realistic. Cost model is supposed to be less, less accurate. So you are moving from a better thing to a worse model. You are moving from an accurate thing to an inaccurate thing. So this is something which is not really appreciable. Yes, if you have cost model under IAS 40, and then you say, I want to move to fair value model, everybody will clap. Everybody will say, well done, do it. So remember this thing that you can make a switch between these models from cost to revaluation and from cost to fair value. So from cost to revaluation model, it is accepted. From cost model to fair value model, it is also accepted because it becomes more accurate. But coming alternative way, coming the opposite way is not really appreciable because you would not be able to justify. You can do it. You want, you can do it. But then when I will ask you to justify me, Why did you move from fair value model to cost model? Probably in most of the situation, you will fail to justify. There could be some specific situation when you had the fair value before, the product had the the investment property had the active market, and you used to calculate the fair value. But then the active market disappeared. So you might have some, empirical evidence in certain situations where cost model to fair value you might move, but generally it is not something which is justifiable. So this is end of your investment property, IAS 40, a short chapter. You remember that the things which you need to understand, that you do at cost model and fair value. Under fair value, you don't charge depreciation. Any gains and losses on IAS 40, they go straight to P&L. Why do they go to P&L? Because it is a manager's decision. So let him take the hit or let him take the credit. And you might have during the year change of classification of asset from IAS 16 to IAS 40. In that particular case, the period for which it was under PPE, you should charge depreciation to the income statement, to the P&L, and then you should calculate the fair value for the remaining period, and change in fair value can also or should also go as a gain or loss to P&L. If you have any question, ask me here. Otherwise, this is all for this standard.